Most people are trying to take a look at where the economy is going or where mortgage rates are going. They tend to take a look at what the Federal Reserve Bank is doing, and that's a good start. But I want you to take it one step further, and I want you to take a look at something called Treasury yields. And more specifically, I want you to keep an eye on the 10-year Treasury yield. A Treasury yield is the interest rate that the government pays when you lend money to the government. Because the government spends money they don't have. Every year, the government carries something called a national deficit. Meaning, if the government brings in $10 trillion of tax revenue, and then they go out and they spend $12 trillion, they spent money they don't have. That's their deficit. But they have to get this money from somewhere, right? If you go out and spend money at Gucci that you don't have, you put it on your credit card, that's where that money is coming from. It's coming from Visa or MasterCard. Well, when the government spends money that they don't have, they have to get it from somebody or somewhere, and that person or thing could be you, regular people, it could be wealthy investors, it could be banks and institutions, or it could also be the Federal Reserve Bank. And this is now the treasuries that investors or the Federal Reserve Bank is purchasing. So when you go out and you buy a 10-year treasury bond or a treasury note, what does that mean? That means you are now loaning money to the government for 10 years. And then the government has to pay you back plus interest. Now you become the lender, so you can lend money to the United States. And the reason why this is so important is because, well, the interest rate that the government pays is known as the risk-free rate. Every economics and finance book in history has always said that the least risky investment that you can make as an investor is loaning money to the United States government, because this is the strongest government backed by the strongest military, backed by the strongest economy. So they'll always pay whatever they owe. So now, when the government has to pay out higher yields, treasury yields, that means two things. Number one, that means the government has to spend more money paying out their interest. And number two, that means other investments are gonna have to pay out higher yields for it to be a worthwhile investment. Let me start by talking about one on the government side where the government has to pay out more money, because the government has one source of income and only one source of income: you. Taxpayers go to work, they generate an income, and then a piece of that income goes to the government. The government only gets the money from taxpayers through tax dollars, period. So if the government has to pay out more money in interest because interest rates are going up, well, that means that more of our tax dollars are being used to pay out interest payments as opposed to being used to build bridges or hire teachers or police officers or whatever it might be. So when you see higher treasury yields, think more tax dollars going to pay out interest. And what we're seeing right now is that treasury yields are going up to some of the highest levels we have seen since before the 2008 crash. And the reason why that's so significant is because now when the government has this large amount of debt, the United States government today has more national debt than ever before. We're right around $32 trillion. Well, that's not a 30-year fixed rate mortgage. In fact, a lot of the United States national debt is going to be readjusting in the coming 24 months. So when the national debt readjusts, that means it's going to be readjusting at a higher interest rate, assuming interest rates stay high. And that means then the government would be forced to pay out bigger interest payments to their lenders. People like you, people like banks and institutions, people like the Federal Reserve Bank, people like other countries. So when the government has to pay out higher interest payments, well, that means more of our tax dollars are being used by the government just to cover interest as opposed to actually providing a real service or benefit to taxpayers. So that's the first part. This is something we've been covering in Market Briefs, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. It's my free financial newsletter. You can read it in less than 5 minutes every morning, and I got the link for you down in the description below. The second thing that you have to understand about treasury yields is more on the consumer side, which is when treasury yields rise, the 10-year treasury yield particularly, this is like one of the major indicators that a lot of investors like to take a look at. Well, that means if the government is paying out a higher yield, that's the higher risk-free rate, if I'm gonna go out and invest my money somewhere else, I'm gonna need a higher rate of return. Because if this very low risk investment, right, the government is supposedly a risk-free investment, if I can get a 4.2 or 4.3% return on my money that I lent to the government without any risk, I'm gonna need a higher return if I'm gonna put this money into the stock market, or if I'm gonna put this money into the real estate market, Or if I'm a bank and I'm going to lend this money to you to buy a mortgage. So when you see Treasury yields rise, that means that your mortgage rates are also going to rise. It means that the interest rate that you have to pay to get a car will also rise, because now banks and lenders are saying, well, if we're going to lend money to you to buy a home or to buy a car or to get a credit card debt or to buy something for your business, you are more risky than the United States government because you don't have a money printer. So if you want to go and borrow money, we're going to have to charge you a higher interest rate. So when you see higher Treasury yields, you should also think, I would have to pay more money if I want to get a mortgage or a car payment or whatever it might be. Now, I don't recommend you get a car payment, but that's what you have to understand. But then on the flip side, if you are an investor, which I hope you are an investor, especially if you've been watching my videos, I want you to be an investor. Well, that means now you also have to understand what types of returns you can get as an investor. Because if you're looking out to invest money, let's just say you want to buy a rental property, and rental properties are paying you 3% return. Well, now you really have to think twice. Do you really want this 3% return rental property? Now the answer is, or what many people say is, but I hope my property value will increase in the future. Okay, but what happens if interest rates keep going up? Because higher interest rates generally put downward pressure on asset prices. And that also means you're speculating. Now, I understand different parts of the country are different. I remember a little while ago, I was looking at real estate to purchase in Austin, Texas. This was, I think, around 2021 when the real estate market was super, super hot. And when I was looking at real estate over there, it was selling for what's called a 1 cap, meaning 1% cash on cash return. So let's say I was looking to buy a $1 million property. A 1 cap property would mean that this $1 million property, if I bought it all cash, would make me $10,000 of profit in 1 year, assuming I don't have any debt. So I'd have to put in $1 million of my own money today to make $10,000 of profit over the course of a whole year, less than $1,000 a month for my $1 million investment. Now I was like, that's a very bad return. But the justification that everybody had, at least then, was, oh, you can just sell this property in a few years for a big profit. That's where the money is. The money is not in the cash flow. So this is where you start to see a lot of different types of investments being made. For me, I don't invest for speculation. Most investments, that's too risky. When I invest in something like real estate, I want cash flow because that's much more consistent and easy to predict. But now when you see higher Treasury yields, an investor is going to say, maybe I should have put so much money in the stock market. I can just buy bonds because I can get better returns from my bonds. That's the justification that you see. So why does that matter? Because then when you have investors who have pools of cash and they're deciding where do I allocate this money, they're looking at the different options. I have bonds, I have stocks, I have real estate, I have keeping it in cash. And they're going to say, okay, looking at the stock market, I don't know what types of returns I'm going to predict over the next year. Maybe I'm only going to see a 4% return in the stock market over the next year. But a bond, these loans to the government are paying me 4.5% or closer to 5%, which means that some investors are now going to put less money into other asset classes like stocks and put more money into bonds. Now that's good for an investor because now you can get some interest on your money, but that can hurt the stock market because the stock market, the real estate market, every asset class runs on supply and demand. When you have more buyers than sellers, that generally pushes asset prices up. When you have more sellers than buyers, that generally pushes asset prices down. So if you start to see higher Treasury yields, that also means more investors will want to put more money into bonds as opposed to stocks and real estate, which would mean less cash going into stocks and real estate, which would mean less upward pressure into these types of asset classes. So why does this all matter? Well, high Treasury yields, for one, mean that the government is going to have to pay higher interest rates or higher payments on all their debt, and they are already drowning in debt. So that would mean that the government would need more taxpayers, tax dollars, which could mean more taxes in the future, potentially. That's part one. Part two is when you go out and you borrow money, whether it's to get a mortgage or to buy a car or to finance something for your business, higher Treasury yields mean you're going to have to pay more money because you are a more risky investment. Part 3 is on the investor side. For investors now, when you have higher treasury yields, that means that's another option for you to invest your money, which means less cash going into other asset classes like stocks and real estate, especially at a time when people feel like stocks and real estate are overvalued. So at least you can get some sort of return in something like a bond or treasury yield or treasury bond, treasury note, whatever it might be. So this is where, again, it pays to be financially educated because you want to understand how treasuries play a part in our economy, because when you see higher treasury rates, that can impact all different facets of the economy, especially at a time where consumer spending is becoming so difficult. People are struggling to keep up with the higher costs of things. And when you keep seeing higher interest rates, that means your credit card payments go higher at a time where credit card debt just broke $1 trillion for the first time ever, where getting a mortgage will become more expensive, where getting a new car becomes more expensive. So higher interest rates mean less spending, which also hurts the economy. And if investors feel worried about the stock market or the real estate market and they can get a better yield by giving their money to the government, well, then you can see more investors doing that, which could impact the prices of stocks, maybe even real estate. And this is where this understanding now how the different parts of the economy play into one another, because bonds really haven't played out a strong or any sort of interest in almost 15 years. And now you're starting to see that happen. So the question is, if bond yields keep rising, if treasury yields keep rising, what's that going to do for all the other parts of the economy? And this is where, again, it's so important for you to get financially educated, because 2023 needs to be the year that you do not go out and finance a new truck. It needs to be the year that you go out and you work to build your financial education. I talked a lot about how all these factors impact investors and people in my latest investor summit. If you haven't watched it yet, I will link it for you down in the description below.